Have you ever wondered how your interest rate's made up as a borrower? Well, today we're going to have a chat about that. I'm Adam Keane from Homestead Agribusiness. Let's get into it. A lot of attention in the media these days about the Reserve Bank and cash rates and things that influence our lenders' capacity to have funds available to on-lend to you as borrowers. And today I just wanted to talk through how that impacts your rate as a borrower and how those different products are calculated so that you can have an understanding on how that works for you and your business. The cash rate's only one part of an interest rate calculation. As a borrower, there's several factors that influence what the outcome is for you as an interest rate. These things include the financial markets, which the cash rate makes up a part of. Also the bank's funding costs, how they raise capital internally to pass on to you. And then thirdly, also your risk profile as a business. And that's the biggest item that's in your control in terms of managing your interest rate costs. So within your risk profile for the business, things like your financial performance are taken into consideration, what your historical repayment capacity has been, what your future repayment capacity will be, what the collateral rating of your facilities are, so what security supports those debts, and also lastly your character and experience as a borrower. So if you've got a great track record of repaying your debts, then that stands you in good stead to make sure that you can keep your interest costs as low as possible. There's two different types of interest rate products available to most borrowers in the market. The first is a market rate based product. This is determined off the bank bill swap rate for most lenders. That's a freely published rate that's in most financial papers every day, so you can check on what you're being charged. Gives you some transparency. And then the funding costs for the term of your facility plus your risk profile are blended into a client margin that sits on top of that rate. So it does give you great flexibility for things like interest rate hedging and more sophisticated financial products that can give you some risk protection from rising interest rates in the future. Generally, that rate's a more transparent type product, results in you knowing the funding costs for the term of your facility, and also gives you a clear indication of what the base market rate is doing at all times. The other type of product that's in the market is a bank determined rate. Basically, it's also based off the bank bill swap rates, but the bank builds the funding costs into that base rate profile. So you do lose a little bit of transparency, but your client margin effectively becomes your direct funding risk profile, and you can take control of that as a borrower over the term of your loan. If the bank's funding costs do move, they do change those rates to increase their base rate to cover that funding cost over the term of your loan. So you do lose a little bit of transparency, but does come back to you in terms of flexibility, in terms of being able to pay down your loan and draw back on it in most cases over that seasonal cycle in your business. If you'd like to chat some more about what rates are available, what product types you're currently on and how that suits your business, then feel free to reach out and give us a call. We'd love to hear from you and help you get the right product in place for your business. Catch you on the next one.